But another thing that we've done here, we've provided this link here. I don't know if you've ever used these links, but if you click on this link, it says to find other estimates or symbols. If you click on this link here, it will take you into MSN. And the reason we put that link on there is because MSN offers the same type of aggregation information, but from Zacks. So you get a little detail here. Now you've got, and this is giving you some more information you were looking for. Now you can see that we have a slight different number of analysts here. We've got somewhere between 22 and 25, and Capital IQ had 27. So now you see a slight difference here, but you also see what the high and low estimates were and whether they've increased or not. So you get some, and then you get growth rates here, but then at the bottom down here, then you get the consensus estimates. Now so here you got 9.9%, and there are roughly 25 analysts, and you can see what their high and low numbers are. So you get a little more detail here in the estimates. Okay, and you also just get some more detail over here. But this link, by going to that link, it just now allows you also to corroborate. So 27 analysts at 10. If you put Zacks in here at 9.9, you haven't really changed anything.
Right.
Okay, but it does give you the ability to corroborate, if you will, what you're looking at. So see, 9.9 changed this by 1/10 of 1%. It didn't change anything. And that's what this valuation corridor is for also. But that's provided there just to give you another source of data. Because the idea, we call this tools to think with, is you want to try to, in other words, the idea here is you want to try to draw the best calculator, the most accurate calculator you can. And if you had a reason, you could even put if there was a reason for you believing, say, that McDonald's was going to generate, say, $9 a share in earnings in 2012, you could also go in here and just put in the $9. If there was, they were going to do something to generate this windfall. So you could also plug that number in, and then you'll see it's always in red ink, and you'd get this crazy number here. But I still have the next year's number. Remember, I didn't grow that from there. That would be if you wanted to put an anomaly in there. But again, it's just designed to be something you can use to think with. And it creates, and then this would be what the historical chart would look like if 2012 was actually going to be huge like that, which obviously is an erroneous chart. But the interactiveness of the tool and the ability to do some of that. Now, is there any stocks you want to look at? Do you have maybe you?
Can I ask you another one?
Yes.
Could you explain, go through the 10-year note and PE ratios and the price sales monthly charts?
These charts here? Sure,
Yes.
sure. I'm gonna expand this out a little more so you have a little more. Actually, I'm going to take this out to the whole chart here. I'm going to take this out to a 20-year chart to do that. The idea of those charts are, and it's kind of funny that you asked that question, because typically in the 40-some years I've done this, when interest rates were falling, like you have during this period right here up to 1999, price earnings ratios were expanding, would normally expand. And the logic there, John, would be that the lower interest rates are, the less competitive bonds are to equities. That, in other words, when rates get real low, then people would theoretically create more demand for equities because they're not getting enough return from a bond. That's the theory.
Like what's happening right now.
But that's not happening right now. What's happening right now, both PE ratios and interest rates have actually dropped. And that's a very unusual circumstance. What you're seeing here in these first 6 or 7 years is what would be normal. You would see price earnings ratios expanding as interest rates were generally trending down, for that theory that I gave you. So this is very unusual right now. But having said that, what this does is if, and there's only a few dots here, if you put your cursor on this line, so what this is saying is that 12/31/1993, McDonald's traded at 19.7 times earnings. At 12/31/94, it traded at 17 times earnings. 12/31/95, it traded at 23. So this allows you to just look at what historical, because in other words, you're seeing the prices up here. The normal PE is 19 on this historical graph. The Graham-Dodd PEG ratio, what we call the extrapolated formula here is 15. So you've got 15 to 19 times earnings, but obviously McDonald's was trading at a higher PE there. Here you get that. You see it on December 31st, which would be right there. when the price was 38.41, it was actually trading at 29 times earnings. And then you can kind of see the lowest price earnings ratio it traded at. That was December of 02. It traded at 12.1 times earnings. And then, through this point here, make sure the line is blue, because if the line turns red, you're picking up interest rates. See, the box is red in the box? So here I'm looking at what 10-year T-bond rates were. In 1231, it was 5.07. At 1231, it was 189. Here, the 10-year T-bond was 4.65. Here, it was 5.9, and back here, it was 7.62 in September of '94. So this is just allowing you to get, pick up some historical data. Now, have you ever done this? Have you ever pointed at that and looked at them like this?
I really haven't, because I wasn't really sure how to use it.
Yeah, well, that's it. The idea here is it allows you to, look at what price earnings ratios were, but you only get a few dots here, so you only get a few points. All right, and then you can also see, interest rates in May of '96, they were 6.85. And then of course, McDonald's PE was real low here at 12 times earnings in '02, which is obviously right here, which was, or I missed it, wherever it is. It would have been a 12/31/02. So there it is right there. See, that's the best time. That would have been the best time in the last 2 decades to buy McDonald's.
Would you like to buy it at $16?
Wouldn't it be great, wouldn't it? but even more important, John, was the PE ratio, I think. The idea that you were only paying 12 times earnings. So you were only paying 12.1 times earnings to buy it. So that's what this is giving you. This is allowing you to look at, like right here at 10/31/07, you could kind of get pretty close to that and see it was trading at around 20 times earnings, 19.3, which correlates to this here. See how that's working? So that's that one. This is just price per sale. So this is just a graphing of sales, and this is sales per share. So you can look at, what the company's sales per share are. And then, of course, when it turns blue, it's the price to sales. So when you're looking at McDonald's, right now the price to sales is probably pretty close to average. If I go back in here, it was trading at, 2 3/4 to 3 times sales, up to 3.5 times sales. The highest it's ever been is 4.5 times sales. It's currently 3.34. So this is on what I would call the mid to high side of price to sales. It's not, like right, and back here again in that '02 period is only trading at 1.1 times sales.
Well, that's really a good chart.
Sure, absolutely. Absolutely. And I don't think anyone's probably, and this is another one of our failures to communicate. Because
it's a great chart, Chuck.
Yeah, because it allows you just to, to get another valuation measurement, John, is the idea. Another fundamental. Now, we're also hoping to add more fundamental data to this tool. And what we're trying to decide is whether we add it to this chart already, because everything is so busy here already. There's so much here that some people just don't see, unfortunately. But we're also thinking about just doing it to links, like having a box and say for other financial data, you could click here and then you would get something that would be like, you'd get returns on equity and, blah, blah, blah. We'd throw a lot of other stuff out there. But we haven't done that yet. That's something we're working on.